Hello, everyone. This is Michele Floriani. I'm the Chief Marketing Officer at Sequoia Consulting Group. It is my pleasure on behalf of the whole team and all our speakers today to welcome you to our webinar. We're very excited to get things going for you. So let me just dive right in, get comfortable. We have a lot of great stuff to cover today. Before we get going, my legal friends always ask me to put slides like this in front. And really, it's a reminder that today, not only we're going to unpack a lot of things about self-funded strategies, but we're also going to connect the impact of COVID to those discussions. And COVID-19 is an ongoing discussion, as I'm sure you well know. It's changing regularly, daily, sometimes hourly. So just know that the opinions and ideas shared today may change over time if you're, reviewing this webinar, let's say 6 months from now. Certainly the facts and the guidance would have evolved. So that was that. We have a terrific lineup of speakers today. We're very excited and very humbled to have them all for you today. We have, ranging from lobbyists to actuaries to experts in the pharmaceutical industry to compliance and a lot of the practitioner aspects and strategic aspects of self-funding. So very excited to get you off and running and hear from these great speakers. General use of time, as you see right here, will take us all the way up to 11 a.m. Pacific time, where we will adjourn with some closing thoughts and send everyone on their way. A little bit of housekeeping. Everyone's in what we call participant mode, so it's listen-only mode, so I can't see you and I can't hear you. But one way you can certainly communicate with us is through the QA function, and that's there to collect any questions that may come up as you see the content. If we have time, we'll answer some at the end, but it's a pretty packed agenda. We will certainly collect those questions and seek to get you answers or responses of some sort through one of the experts or through Sequoia. And we are recording this, so that's often a question we get at the end of these. And so we'll post it soon after up on sequoia.com for you or any of your team members or friends who may want to check it out after the actual webinar. So let me start off just doing a little context setting here about the landscape that's in front of us. You certainly don't need me to tell you it's a pretty unprecedented time. In fact, one of my favorite quotes recently, Bob Lawson, our CFO, we were doing a webinar last week, and he brought up a stat that someone was doing word search metrics and said that the word unprecedented was used an unprecedented amount of times in the month of March. It is certainly a unique thing that's impacting businesses right at the bottom line, but that's also unpacking in the need to have discussions about other ways to manage costs, to manage healthcare, ways to keep people safe and healthy, and it's certainly making this discussion much more interesting than we'd probably like it to be. 30% of companies expect that COVID will impact their healthcare costs in 2021. And that's also making people look at different strategies and different approaches, not only on the funding side, but really on how do you take care of the ongoing and different kinds of needs that we'll have in taking care of our people. As I'm sure everyone here has some general appreciation of, there's a spectrum of options when you're thinking about funding your healthcare strategy. And today, I just want to call out, we're talking specifically on this self-funded, the ASO with stop loss. So this is what the experts will be talking about. We're going to double click and go into this section, this topic specifically. And so really, who is in self-insurance today? Everyone knows that large companies obviously tend to look at this. For a lot of the times there's a healthcare strategy that they're trying to solve, that cost is a big part of that. Also the access to data, right? It suggests here, as you can see in the bottom half, better access to data, 77%, which suggests that employers now are getting way more involved in actually trying to solve and take care of their employees' needs. And when you get better access to data, you can do something about it. And with all the innovation that's happening in healthcare and different kinds of well-being, knowing where your claims are and knowing some of the root causes that are driving those gives you an opportunity to do something about it, take care of your people in new ways, and offset the costs as part of that strategy. So Let's start off. I'm excited to get things rolling with James Slotnick. James is a very well-versed speaker, talks a lot on topics tied to healthcare, and he's going to tie in COVID and the upcoming elections, give us kind of a great kind of some more context for the follow-up discussions that go a little bit more into specific categories. I think you'll really love him as our lead-off batter today. So James, the floor is yours. Thank you. Oh, James, you may be on mute. Check your mute. Thank you. Awesome.
Can you guys not hear me? Because I'm unmuted. There
You're
we
good.
go. It's the beauty of Zoom. Doesn't matter how many calls you do, you always start off on mute. It's unbelievable.
That's how they know it's not a pre-recorded thing.
It's live. You know, these things happen. You got to roll with the punches. No, thanks for having me. I know, appreciate the opportunity. First of all, Sequoia is a great partner for Sun Life. And also for those of you joining today, we all realize certainly one thing that has increased in an unprecedented number, I like that opening, is the number of webinars that you can attend. There's like 10,000 webinars a day now. It's unbelievable.
Wow.
So thanks for tuning into ours. I made up that stat, by the way, that 10,000. That was a rough estimate but there are certainly a lot. Certainly it's been it's interesting. It's an interesting time to be a lobbyist. And I don't mean interesting in a good way. It's just it's been every role is so challenging right now. Shifting to working from home has shown myself something I didn't realize you can effectively lobby from your office, but you can. It's more difficult without the face-to-face interactions, and it certainly has been necessary to continue to engage both on the state and the federal level, and I'm sure your company's government relations folks have been doing the same. The pace of legislation over the past 2 months has been incredible. It certainly, the pace is slowing, but it doesn't mean that there's still not going to be really impactful pieces that are going to happen, or really impactful changes that are going to happen in the next few weeks. We'll see the fifth coronavirus package come through probably next week, and it is at times hard to figure out what are the more important things to focus on. So in my section today, we're going to try to spend some time on not just the changes that are coming from COVID-19, but also look a little bit into the future around what this means, what non-COVID-19 issues we want to be focusing on, particularly as we get closer to November 3rd. We have a good sense of what Vice President Biden and President Trump, what their priorities would be around healthcare in 2021. And we're also going to spend some time around a topic that, depending on where your employees are across the country, you may already be in a state that has paid family and medical leave mandates. There's no question that COVID-19 is accelerating the paid family and medical leave conversation, and we'll talk about why it's likely, regardless of whether it's President Trump or President Biden in 2021, we're going to see in the next 2 years some type of national paid family medical leave program. And then we will spend a few minutes on the 2020 elections, just some things to think about as we try to figure out what everything is going to mean. So, Mikhail, if you could go to the next slide, and actually if you could just go one more. So again, as I mentioned, the 47 days between March 6th and April 23rd were intense for so many different reasons, but just from a pure legislative perspective, that's all I'm focusing on right now. To have 4 pieces of legislation pass in that period of time, and not 4 small pieces of legislation, 4 major pieces of legislation is not the norm. And if you think back to March 6th, when that first package went through, there were a lot of folks that said, geez, and this is Democrats and Republicans, $8.3 billion for COVID-19 preparedness. That feels like a lot of money, maybe more so than we're actually going to need. And then you fast forward just 21 days later, on March 27th, near $2 trillion piece of legislation passed. And then, of course, 2 weeks ago, we had another $550 billion piece of legislation. So things have certainly ramped up legislatively. But as we'll see as we go through the slides, the easy part of legislating is actually over. And this fifth coronavirus package, which again, the Senate's starting to work on this week. The House and the Senate hopefully will vote on it next week, is going to be the hardest piece to get through. But before we get to the fifth package, though, I do, and Mikhail, if you could just go to the next slide, the Paycheck Protection Program, I just want to talk about some of the programs that are in place and sort of what's the next steps for these programs. Certainly everyone's well-versed in the Paycheck Protection Program, designed, generally speaking, for small businesses with less than 500 employees. And the spin around the program is already starting to happen. And again, the spin is important to realize how it's going to affect future legislation. There's a number of different ways that you can look at the PPP, and I just, my own personal sense, it's a pretty good program. It's not perfect. It's hit some speed bumps, no question about it. But to stand up this program as quickly as the Treasury Department did is they did a pretty good job. Again, it's not perfect, and I give Secretary Mnuchin a lot of credit for trying to fix some of the problems that the program has had, literally on the fly. And so, what we're going to, the real thing that will come out of this is when we get into sort of the looking back at what's worked and what hasn't, is it really depends on how you want to look at the numbers that are on your screen there. And there's the two rounds, the first $349 billion on the left, the second half, or at least half of the $322 billion in the second round. The program is doing a good job of getting a majority of the loan applications that are being approved are from the smallest businesses in the country. So you can see in the first round, 74% of the loans that were approved were for businesses, were for less than $150,000. The second round, we're seeing 90% of the loans approved for businesses for less than $150,000. And remember, because of the prescriptive nature of the program, the payroll, and if you've taken a loan, you know the math. It's figure out your average payroll, monthly payroll cost, multiply it times 2.5. So if it's less than $150,000, it's at the lower end of the employee number. So the smallest businesses of the country, they're getting the majority of the loans. The flip side of that is a small percentage of the loans are taking up a tremendous amount of the money. So in the first round of the program, we can see how Secretary Mnuchin, some actions that he's taken has had an impact. In the first round of the program, 4% of the loan recipients, so 67,000 businesses, received 43% of the funds. So in that first round, 67,000 businesses received about $160 billion. And so that didn't really sit well with a lot of folks, particularly when you started to dive into some of these things, and you're seeing small businesses like the Los Angeles Lakers were getting these loans. It really wasn't the type of business that these loans were designed for. On the flip side, though, the way the program was written is it essentially said, if you have less than 500 employees, or you're a hotel or you're a restaurant, and you have less than 500 employees per location, and you feel like the current economic conditions make it necessary for you to apply for these loans, you can get them. And so certainly we've all seen the headlines of the companies that have gotten the loans and put them back. And so the difference, what's happened between round one and round two, is that Secretary Mnuchin has put some rules in place that essentially say, if you're a public company, you're not supposed to get these loans. If you have other sources of capital, you're not supposed to get these loans. And if you receive a loan for more than $2 million, you are going to be audited at the end of the program to determine if you actually needed these loans. And so you'll see in the second round of the program, now less than 1% of the loans are for over $1 million, and only still a lot of the money. The 1% of the 1% of the recipients are now getting 27% of the value of the program. So we've seen the large loans decrease in the second round. Again, certainly Secretary Mnuchin has tried to put some guardrails in place. We'll have to see where this sort of continues as we move forward. But the Paycheck Protection Program, make no mistake, not going anywhere. Very possible we could see a third round of funding for the PPP. And at the end of this, about 4.5 million small businesses will likely get a Paycheck Protection Program loan. So if we go to the next slide, the next thing that's going to be coming in terms of support for businesses is the Main Street Lending Program. Now, this is a program that's going to be run through the Federal Reserve. There's going to be $600 billion with a B, $600 billion of loans that are available. These loans will be available for businesses that have less than 15,000 employees. So if you received a Paycheck Protection Program loan, guess what? You can also get a Main Street Lending Program loan. It's open to all businesses that are under 15,000 employees. There's some huge differences between the Main Street Lending Program and the Paycheck Protection Program. The biggest one is that these loans are not forgivable. Main Street Lending is going to be like a traditional loan that you would get from a bank. It's not going to be completely traditional, but it's going to be something you have to pay back, sort of a more traditional loan arrangement. The loan values, this is another huge difference. The maximum loan values are going to be between 25 and 200 million. There's some technicalities of how you get to those numbers, but it's not going to be the prescriptive nature of the Paycheck Protection Program where you take your payroll costs, multiply times 2.5. This will be you say, hey, I need $50 million, and the bank either approves or doesn't approve you for that amount. It's a 4-year loan program, low interest rates, no payments for the first year. If you're thinking about your business maybe needs some cash over the next year or two to keep you going, this is a great alternative to the Paycheck Protection Program. The thing you want to remember, and I'm not going to spend too much time on it, certainly the folks at Sequoia can help you with this. Sun Life's not a bank. Sometimes it feels like I work for one talking about these programs. There's going to be 3 major restrictions for businesses that take these loans. One, huge executive comp restrictions. If you take one of these Main Street Lending Program loans, for the term of the loan plus 1 additional year, essentially any employee that makes more than $450,000, their salary is going to be frozen for the next essentially 5 years, term of the loan plus 1 year. So let's say that in 2019 I made $750,000. I didn't, but wishful thinking. Let's say I made $750,000 in 2019. The company I work for takes one of these Main Street Lending Program loans. I am locked in at $750,000 for the term of the loan plus 1 year. I could certainly make less, but I'm not going to be able to make more. If I leave the company, my severance cannot be more than 2 times what I made in 2019. So some pretty restrictive executive comp handcuffs go in place if you take these loans. Additionally, if you take this loan, no stock buybacks for the term of the loan plus 12 months, and no capital distributions for the term of the loan plus 1 year. Now, in terms of capital distributions, there is a little bit of an exception for S-corps or partnerships, organizations that are structures that generally would make capital distributions. You're still going to be able to, but only up to the extent that distribution needs to be made to pay taxes for the pass-through entity. So again, relatively severe restrictions put in place for companies that are going to take these loans. The reason for that, this looks very much like TARP did back in 2008, 2009. The government doesn't want businesses taking these low-interest loans there's no collateral that's needed for these, the non-secured loans, taking these loans and just paying their executives or paying their shareholders with the funds. These loans, again, Federal Reserve is going to roll these out either this week or next week. These are going to be available through your regular bank that you go to, similar to how the Paycheck Protection Program loans worked. The difference between these loans is the last thing I'll say on this. The reason why they think banks will be interested in these is the Federal Reserve is going to buy between 85 to 95% of the loans from the banks. So there's $600 billion of funds that are available. The banks make the loan. They get some upfront, a 1% origination fee upfront. The bank is then going to be able to sell the vast majority of the risk to the federal government, to the Federal Reserve. If these loans default, it's us, me, you, the taxpayer, that's going to be on the hook for these. Again, the federal government essentially is going to buy the vast majority, up to 95% of the risk, at a minimum 85%, at a maximum 95% of the risk of these loans. I talk about this just because for some reason I don't think it's getting enough attention, but there is, again, $600 billion for companies that have less than 15,000 employees that's going to be coming available in the next few weeks to, again, continue to make sure that companies can keep their employees on the books and hopefully keep the economy going. The real last thing I'll say on this, unlike Paycheck Protection Program, the requirement here is that you make a reasonable effort to maintain your employees. Remember, paycheck protection, we all know the rules about keeping the same number of employees and the different time periods you have to measure. The Main Street lending program is not forgivable, and so they're only requiring you to make a reasonable best effort to maintain your employees. Now, what exactly does that mean? Hard to say, but there's not going to be nearly as much emphasis on it as is in the Paycheck Protection Program because of the loan forgiveness provisions. So we go to the next slide. The thing that's coming together it's really started to come together in the last week and a half are COBRA subsidies. Now, I know later in the presentation there's new rules around COBRA and time periods. Thank God you have a COBRA expert because I'm certainly not one. What I'm going to mention here is for your employees that are laid off or furloughed, but you've made the furlough a COBRA qualifying event. Again, experts can explain to you what exactly that means. The federal government is looking to do something similar to what President Obama, Democrats and Republicans passed back in 2008. In 2008, for a period of time, 65% of COBRA premiums were paid for, subsidized by the federal government. What Democrats and Republicans are working on right now is something that's significantly stronger than that. The current proposal is a 15-month, 100% subsidization of COBRA premiums. Now, listen, I don't think we're going to get 100% subsidization for 15 months. That's sort of the marker that's out there. But you're seeing an interesting marriage of Democrats and Republicans both supporting COBRA subsidization for maybe different reasons. On the and I'm not saying that these are mutually exclusive, but more generally, the Democrats are more willing to accept the COBRA subsidization because they think it is the least disruptive thing that could happen to the employee. So I get to stay on my employer's plan. I get to keep my same healthcare provider, my same network. Nothing changes for me. I'm still within that same plan that I was before. And again, I'm generalizing, but that's sort of what Democrats are focusing on. On the Republican side, they're concerned about the argument that the far left, the most progressive Democrats are making, and they're saying what the Senator Sanders is saying, for example, is this is the reason why healthcare and your business or your job and your health insurance should not be tied together. When 30 to 35 million Americans are getting laid off, they shouldn't lose their health insurance coverage just because they lose their job. And so Republicans are saying, well, COBRA exists so that you can stay on your employer's plan. It's very expensive, understand that. But if we want to make the argument that the employer-based health system is one that can work and can survive shocks to the economy, then subsidizing COBRA takes away the argument that people lose their job and then they automatically lose their health insurance coverage. So this is something that's gaining a lot more momentum over the last few weeks. And I think it's very likely that we see something between 80 and 100% of COBRA premiums subsidized for 6 to 12 months. And again, the time period likely is individuals that have been laid off or individuals with a COBRA qualifying event between March 1st and September 1st of this year. Now, there's a big price tag with this. It's estimated it could be $40 billion a month. So, as you might imagine, industries that are lobbying for this, the health insurance industry, Sun Life, full disclosure, we're also lobbying for the continuation of COBRA premiums. We have a large stop loss business. We want to keep employees covered by their employer-based coverage, just for transparency's sake. And so there are some that are saying, well, this is really just another bailout for insurance companies where the government's going to spend $40 billion a month so that health insurance companies and other insurance companies can continue to have people on the books, continue to have people on the rolls. I'm compromised on that particular issue, but for transparency, I do want to point it out. But it does seem like we are going to have COBRA subsidization in that fifth coronavirus package. So if we go to the next slide, what's going to be in this package? Well, there's a couple things that both sides agree on. Now, I know you're hearing almost every day from the president that he wants to have a payroll tax cut. Republicans are not with him on the payroll tax cut side. You're seeing some very prominent Republicans come out and say, well, if 30 million people are laid off, the payroll tax cut doesn't really help those people because they don't have a paycheck coming in. And so we're seeing Democratic and Republican support of, we likely need to have at least one more recovery payment. Those are those $1,200 payments that went out over the last few weeks, $500 per child. There is some general agreement. They're trying to iron out some details, but general agreement, we should have a second round of recovery payments. I know you keep hearing the president talk about payroll tax cuts. Just trust me on this. He'll come around. He'll come around to this when more Republicans start to get in his ear. There is also general agreement that hospitals and hospital systems need additional funding. Most of that is because, of course, if you're not in a COVID-19 hotspot, or even if you are in a COVID-19 hotspot, although elective procedures are coming back, although people are starting to get more comfortable going to hospitals for non-COVID-19, there's just been a tremendous decrease in hospital utilization, which has led to huge decreases in revenue, which has put a lot of hospitals at risk. And so there's already been $175 billion that's been allocated to hospitals. There likely needs to be at least another $150 billion. And so the negotiations right now are whether there's going to be $75 billion in this package, or they would fund another $150 billion in this package for hospitals. Also, general agreement that testing resources, testing support for the state needs to increase. And again, COBRA subsidization. Again, the exact details getting worked out, but general bipartisan agreement. That's sort of where the bipartisan agreement stops. Republicans, particularly Leader McConnell, would like to see business liability protection put in place for as you open your companies back up, your employees come back into the office, or you open up your retail operations and customers come into your office. Republicans would like to see some pretty strong liability protection for you in case someone contracts COVID-19. Now, I will say it's been impossible for me or others to get any legislative language around what that liability might look like. So there's a lot of talk about that, but we haven't seen the legislative language yet. On the other side, where the horse trading is going to come in, is that Democrats would like to see states and cities receive grants from the federal government to help them through this difficult time, this difficult economic time. As you remember, as part of the CARES Act, every state received at least $1.2 billion, not for testing, not for hospitals, not for unemployment, to do whatever they wanted with. Now, that was tied to population. So the lowest a state got was $1.2 billion, but states like California, and I don't have New York, I don't have the numbers in front of me, got significantly more than that. Well, those larger states are coming back to the federal government and saying, we need more money right now. We're in a tough spot. And so Republicans are a little less hesitant to provide that money at this time. And so you're going to see some horse trading there, the business liability for the funding for cities and states. So I do think, and there is a desire to have all this mashed together in a massive fifth coronavirus package. So I think over the next week or so, more details will emerge. But it does feel like that will be the trade-off. Some type of business protects liability with some type of city, state bailout, but bailouts, maybe you don't like that word. But also probably some worker protections in there as well. And then last on this, and then we'll move on to some non-COVID-19 items. There is already talk about Paycheck Protection Program 3.0 funding. The details on this are sparse, but not only just funding, but you may have seen yesterday the IRS, yesterday? Every day is the same, but it was either Monday or Tuesday. Today's Wednesday? No, today's Tuesday. Maybe it was Monday. Recently, the IRS came out and said that if you receive a Paycheck Protection Program loan and you use those funds for things that generally would be deductible, if they're using the Paycheck Protection Program loan, they're not going to be deductible. Well, you've seen Democrats and Republicans. I mean, you usually don't see Richie Neal, the chairman of the Ways and Means Committee, a Democrat, and Chairman Grassley of the Senate Finance Committee, a Republican, both come out and say, that's not what we wanted. We wanted money with the Paycheck Protection Program to be deductible for businesses to give them an extra incentive. So we could see in this package, if it's not funding for Paycheck Protection Program, some tweaks to the program as Treasury's made some guidance decisions that some of the legislative folks aren't so happy with. So if we go to the next slide, so that's sort of where we are with COVID-19 legislation. I do want to spend a couple minutes on some other things. If we go to the next slide, please, that are worthwhile to watch. Not going to spend a ton of time here. Just want to remind you that this fall the Supreme Court is going to hear the third challenge of whether or not the ACA is constitutional. Now, I know there's been a million ACA cases that have gone up to the Supreme Court, including one that was decided late last week, but this will be the third challenge of whether the ACA is constitutional. California, very involved in this case and defending it. Essentially, if you think back to 2017, the end of the year with tax reform, the individual mandate penalty went to $0. In 2012, when the ACA went to the Supreme Court for the first time, Chief Justice Roberts said the only reason the law is constitutional is because the individual mandate is a tax and the government has the ability to tax its citizens. Well, the state of Texas and 20 other states said, well, if the individual mandate's zero, zero's not a tax. And if Chief Justice Roberts said the only reason this is constitutional is because it's a tax, then this isn't constitutional anymore. And so the Texas District Court agreed. It went up to the appeals court. Long story short, last month or 2 months, back in February, Supreme Court said they would hear this case. They'll hear it in the fall. This does give us some certainty. They're going to hear the case in the fall, which means the decision will not be released until after the 2020 election. So that, for political purposes, that's helpful to both sides to know that we're not going to have the finality of this case until after the election is over. But I would just say, as you're talking to your Sequoia consultants, just keep in the back of your mind, if you could go back to the rules of before the ACA was in place in 2010, if you go back to 2009, 2010, 2011 plan design, would you? Would you put back in place lifetime and annual maximums on certain things? It just, there's some, I'm not saying the ACA is good or bad, just there are some plan design opportunities if the Supreme Court does rule that it's unconstitutional. Now, again, lots going to play out before then. Nothing you have to run to your phone and call your Sequoia consultant about today, but just keep that in the back of your mind. If we go to the next slide, we have a good sense of what both Vice President Biden and President Trump would be looking to do, either Vice President Biden in his first term or President Trump in his second term. And just the long and short of it here is that certainly from a Democratic perspective, the employer-based healthcare system is in much safer shape with a Vice President Biden as president than if Senator Sanders was president. Vice President Biden does not embrace Medicare for all. He values the employer-based system. Would he like to see some changes? Absolutely. He talks quite a bit about creating a buy-in for Medicare at age 60, which is sort of a nod to the Bernie Sanders side of things, and also creating a public option, which would be an alternative place that individuals could buy health insurance. So there'd be the ACA exchanges, there'd be the public option, then of course employer-based coverage. I know there's other options as well, but just generalizing. The other thing that Vice President Biden has talked about as a priority is international price indexing for drugs, prescription drugs. You may remember at the end of last year, Speaker Pelosi shepherded a bill through the House of Representatives that would have made it so that each year the 50 most expensive drugs in the United States are boxed in, and they can only charge the average of what they charge in 6 developed countries plus 20%. So in other words, we're going to look at what you charge in other countries. We're going to let you charge a little bit more, but that's all you're going to be able to charge in the U.S. The U.S. shouldn't be charged 100% or 200% of what you're charging for a drug in Canada, Japan, England, and other countries. Ironically, international price indexing, something that President Trump has talked about quite a bit, sort of tapered off, but it was in international price indexing was in the president's 2017 America's Patients First plan, but something that he sort of looked away from. But again, that's not nearly as disruptive as a President Sanders agenda would have been. And then on the President Trump side, again, we have a good read at what his pre-COVID-19 priorities were, because both of these things that are on the screen for the president were 2 issues that were in flight. The president, the Department of Health and Human Services had created 2 proposed rules, one around allowing the importation of drugs from Canada. As you know, personal importation, it's not really allowed, but it's sort of allowed if you only bring in a 90-day supply. But anything over 90 days, 100% illegal, everybody cares about it. What this proposed rule would have done is allowed companies to commercially import drugs from Canada and resell them here in the United States. And the thought process of this was that it is cheaper to have someone go into Canada, work with the pharmacy up there, buy the drugs wholesale, ship them into the U.S., pay the middle people, the shipping costs, all that stuff, and then resell them in the U.S. That's actually cheaper than going through the traditional PBM model. So this was a proposed rule that the president was that HHS was working on. Obviously, got put to the side. No congressional action needed. This was something HHS has the authority for. No action needed. The other thing that the president, a big priority for him, was price transparency. HHS had a proposed rule that said every fully insured health plan and every self-funded health plan will have to publish every single negotiated rate that they have with every single facility for every single procedure. Publish them, make them transparent. Not only that, every single health plan, whether you're fully insured or self-funded, would need to create a calculator. And in that calculator, you can put in, I'm going to go to this hospital. I'm going to get my hip replaced. What is my health insurance plan going to pay the hospital? And what is my ultimate out-of-pocket cost going to be for that? Now, needless to say, this was a pretty big deal. The health insurers were not super excited about this rule. America's Health Insurance Plans, AHIP, the largest lobbying organization for health insurance, came out very strongly against the rule, arguing that price transparency will actually lead to increased prices for consumers. Because what would happen is, I'm a doctor, I've negotiated this rate. I don't know what the doctor down the street has negotiated. If all of this becomes transparent, I'm going to see that the doctor down the street is getting a higher rate, and I'm going to raise my rate and renegotiate what I have with the health insurer. Now, listen, I don't know if that would happen or not, but the health insurers certainly felt like that would be the case. This rule would definitely have been challenged in court, but again, got pushed to the side. So again, a lot squeezed into this slide, but we have a sense of what the president and Vice President Biden would do in terms of their non-COVID-19 priorities if they were in the Oval Office. If we go to the next slide here, I know we're coming up close on time. I'm going to hit my time number. Don't worry. I'm down at 15. I'm guaranteed. So on paid family and medical leave, as I mentioned before, COVID-19 has certainly accelerated the talk of a national paid family and medical leave program. For the folks here, I know a number of you are in California. You certainly know better than myself. California has been the leader in paid family and medical leave. And I will say, your congressman from Los Angeles, Congressman Jimmy Gomez, has been an incredible member of the House of Representatives on this issue. He's on the Ways and Means Committee. Sun Life has worked very closely with the congressman in his office, and he's been given a real leadership position on the Ways and Means Committee because of the work that he did on the California law. So just know, California is very well represented by Congressman Gomez on this issue. The states have been the leader on paid family and medical leave until March 6th of until March 18th of 2020. Until that point, and we had really seen an acceleration over the last 3 years of 4 states plus DC creating paid family and medical leave programs. The problem that states are going to have in the near future is when you look at a state like California, Rhode Island, New Jersey, New York, all in the 1940s created statutory disability programs. So there's infrastructure that was created in the state. Then in the 2000s, they plopped paid family leave on top of that statutory disability. What we're seeing in the new wave of states, and Washington is the best example of this right now, is states are building stuff from scratch. There is no statutory disability program. And remember, the biggest story around paid family and medical leave before COVID-19 was how the state of Washington was overwhelmed by the amount of claims that they were receiving in the first few weeks of their program launching, and how it was really challenging the infrastructure that they had built. Building something from scratch is difficult and it's expensive. As we mentioned before, states are feeling like their economies are not doing so well. They need money from the federal government. There's not going to be the same desire in the near future to stand up state-based paid family and medical leave programs. What that is going to mean is the pressure is going to be put on the federal government. We've already seen with the emergency paid sick and paid family leave programs that have been rolled out, the government can do this on a bipartisan basis. Now, I understand it was for an emergency situation just for COVID-19, but the fact that we now have a blueprint of how to do this, set it up through employers, provide tax credits on the back end, have the employers pay the money, is a significant step. Originally, in the original legislation the Democrats and Republicans were putting together around the Families First Coronavirus Relief Act, the Social Security Administration was going to pay out the paid sick leave and the emergency paid FMLA. The thought process, though, was why would we try to get SSA to do, or Social Security to do something they're not used to, when the employers have the best way to get money to the employees as quickly as possible? If Vice President Biden is elected president, there is no question within the first 2 years that we are going to see a paid family. Buddy, I'm on the phone. Okay, you can go on it. 1 second. I'll go in 1 second. I'll get 1 second, buddy. Not only are we going to be, I'm going to be done at 12:15. I'm certainly going to be done because I got to do something for my son at 12:15. But we're certainly going to see a paid family medical leave program, particularly if the Democrats control the Senate. If there is a President Biden. If there's not a President Biden, though, if it's President Trump, I still think you're going to see a national paid family and medical leave program. Will it be as strong as what the Democrats are proposing, which is essentially a 12-week program at 60% of salary? Probably not. But this is not a partisan issue anymore. And if anyone tells you that Republicans don't support paid family and medical leave, they're being short-sighted, quite frankly. Both Democrats and Republicans understand the importance of this. So if we go to the next slide, just very quickly, just want to go one more slide forward. I think the biggest thing we want to watch on the presidential side of things is if you remember going into 2016 and sort of refresh your memory, going back a number of elections to 92, there was, you might have heard the term, the blue wall. It was the 242 electoral votes that Democrats could count on every single year because 13 states had consistently voted for Democrats since 1992. And a number of states had consistently voted for Republicans. If you go one slide forward, the issue that Democrats had in 2016 is President Trump destroyed that blue wall. Wisconsin, Michigan, and Pennsylvania, all for the first time since 1992, voted for a Republican for president. And so when you hear who Vice President Biden is thinking about in terms of his vice president, certainly the governor of Michigan, that potentially could deliver a very important state. Governor Wilson, Senator Klobuchar from Minnesota, again, that sort of Midwestern need. There's a huge need for the Democrats to be able to retake Wisconsin, Michigan, and Pennsylvania if they're going to be able to win back the Oval Office. On President Trump's side, that's why he's very focused on those states, and certainly you've seen some of the tweets around liberate this state or liberate that state. Many of them have been targeted for key areas. The other three states that President Trump was able to win that Vice President Biden will have to, if he wants any shot of getting the 270 votes that he needs, are states you hear of all the time. Those battleground states of Florida, Ohio, and North Carolina. Ohio is going to be the most difficult, given that President Trump had a pretty significant win there in 2016. But again, those are the states that really matter. For those of you who live in California, or I'm here in Massachusetts, our states don't really matter as much. They kind of, as soon as the polls close, they basically already tell you who's won. But those battleground states, Wisconsin, Michigan, Pennsylvania, Florida, North Carolina, and Ohio, that's where the election is going to be decided. One more slide for me, and then I'll sum up. This is, I get frustrated. Actually, if you go one more, sometimes I get frustrated with people saying Republicans are going to be able, or Democrats are going to be able to take the Senate. I'll leave you with this. The Republicans have 22 seats that they need to defend in the Senate in 2015 or in 2020. Democrats only have 12. But when you look at the places where the Republican seats are up for grabs, a lot of those are traditionally Republican areas. And when you look at some of the states that the Democrats have to defend, Alabama in particular, it's going to be hard for the Democrats to win a net 4 or net 3 seats. So if you go to the last slide, I think the takeaway is we're going to see a mixed government in 2015. So I know I talked about a ton of stuff. Looks like I'm going to hit my time, which is freaking amazing. The key takeaways are: one, Paycheck Protection Program still out there, but the next thing you want to be thinking about is the Main Street Lending Program. A lot more requirements for businesses, but significantly more money that's available. If you're interested, call your bank. The loans aren't available yet, but they will be within the next 2 weeks. But remember, talk to your Sequoia folks, because there are going to be those executive comp restrictions that are put in place. We are going to see that fifth coronavirus package. Look out for that for the COBRA subsidies, partially or fully, because that could have an effect. If you've had to make changes to your workforce, you could potentially have more of your laid off or furloughed employees on your plans than anticipated. As we look to the future, paid family and medical leave, I know a number of you are in states that have mandates for that. It is going to become more of a national issue. We're likely to see, whether it's a Democrat or Republican in the Oval Office, that continue to be a theme. And again, it's going to be hard to see wholesale changes in 2021, 2022, because who's ever in the Oval Office is likely facing a Democratic controlled House and a Republican controlled Senate. So with that, I'm going to turn it back. I appreciate the time. Send in any of the questions, and we'll certainly, when I get them sent to me, I'll send them back to Sequoia so they can send them out to you. So thank you very much.
That's great. James, thank you. That was an excellent synthesis of a lot of stuff, as you said, but you brought it back to us in a very digestible way and connected it to the healthcare topics that we care about. So thank you very much. Have fun with your son. As I announced to everyone earlier in the pre-meeting. Kids, pets, mother-in-laws, everyone's welcome on a Zoom meeting these days. But anyway, have fun. Thanks for your time and your insights.
Thanks.
Appreciate it. You've convinced me you deserve your own cable show on this topic. That was very consumer grade.
Not that hard,
that's
trust
great.
me. All right.
Awesome.
Take care.
Another person who deserves to be on TV, mostly because of his movie star good looks, is my friend Tim Allen. He's a client financial consultant at Sequoia, and today he'll be joined with Frank Chung, who's the co-founder and health actuary at Cerebrae. And what two better minds to unpack for us some of the financial aspects of self-funding and again, how COVID-19 plays a role in these decisions. So Tim and Frank, thanks for joining us. Tim, I think we'll start with you. I'll hand it over to you.
Great. Thanks, Michele. And just want to echo, thank you, James. That was really good stuff. So appreciate that. And just want to, thank everybody on the call today who joined. I know everyone's schedule is pretty busy right now, so we really understand that and certainly appreciate it. So I'm really looking forward to speaking to you all today, cover some of the financial aspects that an employer should think about when considering self-funding. And at the end of this section, we'll also touch on how COVID-19 may play a role into some of these decisions this year and for the years to come. So just a quick intro of myself. Like Michele said, my name is Tim Allen. I'm a client financial consultant here at Sequoia on our enterprise team. So I mainly focus on our larger clients who are considering self-funding or maybe already self-funded. And I really partner with the client's HR and finance teams to review self-funding feasibility, different cost mitigation strategies, and reporting and analytics. And I'm also joined, like Michele said, by Frank Chung from Cerebrae today. So I'll give him a few seconds to introduce himself as well.
Hi, everyone. My name is Frank. I'm a health actuary, also co-founder of Cerebrae. Cerebrae is an actuarial technology company. And the way to think about what actuaries do is that actuaries work for insurance companies to help manage financial risk. The reason why it applies to the benefit space is because as a self-insured employer, you are essentially operating as a mini insurance company, managing the population health of your company. So I'm going to go ahead and pass it back to Tim, and then we'll jointly present these slides.
Great, thanks, Frank. So really wanted to start our section today with a high-level overview of some of the major differences between fully insured and self-insured plans, and also some of the pros and cons and main considerations that we like to think about when we discuss self-funding with clients or prospects. So high level, think of a fully insured plan as a sort of a set it and forget it approach, whereas self-insurance does take a little more work to manage, but can ultimately be very cost-effective and customizable as well. So we start with the pros. So fully insured plans, I think the general consensus is they tend to limit risk with much more consistent monthly costs. There's also the ability to negotiate rates on an annual basis with the insurance carrier, and claims are ultimately managed by the fully insured carrier themselves. However, on the flip side, there is the potential for higher costs due to extra fees, taxes, et cetera, that get baked into the premium that you pay. And there's also potentially some plan design limitations and lack of data transparency, which really gives the ability to see under the hood of claim costs and what's truly driving plan spend. On the other hand, self-insured plans, they have the potential for savings in the long run, since they do remove a lot of those extra costs I just mentioned. There's also the potential for increased plan design flexibility, carve-out strategies, and data transparency. However, on the flip side of that, they do bring higher risk with potential for monthly fluctuations in costs as a result of claim fluctuations and potentially catastrophic claims. Another piece that we always like to stress is self-insurance really is a long-term strategy, and savings may not appear immediately. It may take a couple years to realize any quote-unquote savings. And lastly, there are also some new plan sponsor responsibilities and compliance considerations that we'll get into later in the webinar today. And Michele, if you hit the animation. So we'll really focus on these two for the potential for savings in the long run and higher risk over the next few slides. So to understand how we really look at self-insured medical costs, we wanted to start with a sample of a 2021 basic self-insured medical projection to try to estimate costs for the next year. And if you hit the animation. So the first step really is to start with credible medical pharmacy claim data, preferably at least 24 months, and making sure that we remove any claims that hit over the individual stop loss level, since those claims ultimately will get reimbursed back to the plan. And just to note, all these costs are on a per employee per month or PEPM basis. And if you hit the next animation, so we'll take those claim estimates, we'll trend them forward based on how many months out from the renewal period that the data is, and our annual trend percentage assumption. So we're using a 7% trend here. You'll see that fluctuate across the industry, but mid-single digits is pretty consistent with what's in the marketplace right now. Fully insured trends do tend to be a little higher, and on the flip side, the larger an employer is, the lower the trend tends to be. So we go to the next piece. After this step, so we'll blend the two experience periods together, we'll get a projected claim number, and that's highlighted in the red there, the 1,017 and 70 cents PEPM. We'll look at that and we'll consider historic claim volatility, and we'll apply potentially some adjustments like manual adjustments, demographic adjustments, if there was a shift in enrollment, or any plan design adjustments to really get that final expected claim cost. And the next piece, we just simply would add fixed costs. So this is everything from administrative fees, consulting fees, stop loss fees, etc. And then ultimately highlighted in red at the very bottom, that 1,203 and 87 cents PEPM, that's our fully projected cost for the next year. And this is based on 500 employees. So annually, that would be about $7.2 million in spend. And if we go one more animation, so just a few final things to keep in mind with something like this. There's certainly volatility in this projection, and we'll discuss that in the next few slides. But I also wanted to call out that this is a mature cost estimate, which is really a full year's estimate of claim spend. And just to note, typically when an employer goes self-funded for the first year, there's a lag in claims in the first few months, and that tends to pick up later in the year. So this is a really good time for an employer to build a reserve to account for any run-out claims should the self-insured plan ever get terminated in the future. That's also known as IBNR, or incurred but not reported liability, and that's something that we can help with calculate throughout the year. So if we go to the next slide, so now we'll really take a look at, well, how feasible is this? It's great we have a self-insured projection, but does that really save us money? So ultimately, the best comparison point, or one of the best, is to take a look at current fully insured costs, as well as the actual fully insured renewal. So on the left here, we've summarized the fully insured spend on a per employee per month basis. That's the $974.89. And then we annualize that to about $5.8 million in medical spend. Just to the right of that, we see the renewal came in at 26%. So not a great renewal to start, but that's where it stands as of now. So that's an increase of about $1.5 million. On the right side of the slide, you can see our self-insured comparison for 2021. So really, if we use that same claim projection that we just reviewed in the prior slide, you can see that PEPM projected claim amount plus the fixed cost, that will all roll up into one cost estimate, that $1,203.87, which if you annualize that gets you to about $7.2 million. So still a decent increase from current, about 23%, but there is some savings from the fully insured renewal, about 2% or $147,000. And just to the right of that, we have scenarios in case claims run a little better, 5% better in this case, 5% worse, or all the way up to the maximum liability that would be covered by aggregate stop loss coverage. And I do want to illustrate, so Michele, if you hit the animation, so as the fully insured renewal increase gets updated or potentially negotiated and comes down, that's going to eat into the perceived savings of going self-insured. But the one thing that we really like to stress is, kind of like I mentioned earlier, we don't see this as just a one-year cost-saving strategy. It really is a long-term strategy that we like to think at least, a few years down the road. So on the next slide, I'll turn it over now to Frank, and he'll talk through some of the actuarial models that can be used to determine the likelihood some of these scenarios happen, as well as how COVID-19 might impact costs this year and the years to come.
All right, so I know there's a good mix of those employers out there who are listening in who are self-insured but also fully insured. So when you're thinking, for those fully insured individuals that are thinking about whether or not self-insured is the right option for them in the upcoming years, it's really thinking about what the distribution of opportunities and risks are. So, anytime we think about self-insured insurance, we always think that maybe on average over the long run, we're going to save money, but what does that look like next year in terms of my risk distribution? And so using a Monte Carlo simulation for Cerebre's self-insured projection model, we get a sense of this particular case. And this is going to look very different for each employer depending on where the fully insured rate is coming in, what the fixed fees are, like stop loss and administrative fees that Tim walked through. But really the way to look at this is that for each row, you have a 10% chance of having this financial outcome based on the underlying cost models that are being applied to this particular plan. So on average, we're looking to save about $97,000, which is 1.3% in savings. But in terms of your top line risk, you have a 10% chance of saving $1 million, $1.006 million, which is 13%. And you have a 10% chance all the way on the bottom of spending about 7% more. So really taking this full picture into account into making your decision allows you to make a more informed bet, so to speak, on whether or not self-insured is the right way to go from a financial perspective. Obviously, there are many other other non-financial considerations that you need to think about and weigh as you think about self-funding. Michele, can we move on to the next slide? As you can see, based on this simulation output, we're looking at about 50% of savings. Again, this will differ from employer to employer depending on the circumstances. If you move to the next animation, you have 50% that there won't be savings in this situation. And then we can go to the next slide. And to the next slide. Great. So how does COVID-19 impact projections for those companies that are currently self-insured, as well as how does it impact considerations for those companies that are fully insured and thinking about self-insuring next year? As you can see, I'm not going to read all of these considerations verbatim. The biggest takeaway for COVID-19 on the impact to your projections is that it really depends on your company's situation, what your underlying demographics are, because we know that COVID-19 impacts the older demographic population more than the younger demographic population. We know that your region makes a big difference, where your employees are residing. It's going to look very different if you're currently in New York as opposed to California, as opposed to suburban Georgia. The cost of medical procedures in different geographic areas is also going to play a big impact, as well as how your stop loss policy is structured and the parameters around that. So when we think about how does COVID-19 impact your current 2020 projections, it really depends on many factors, which includes a deferred elective medical spend. So we know that we've seen a reduction in deferred medical spend or elective medical spend, and whether or not it's going to come whipping back in 2020 or whipping back in 2021, that's going to impact how your 2020 medical budgets are going to be impacted, as well as how your 2021 medical budgets are going to be set. So if we move on to the next slide, we've built a financial impact model to measure these impacts and to take into account these different variables. So here is just one example. And again, your situation will definitely vary of how COVID is going to impact your medical budgets, but it's definitely something in terms of the severity of these cases and the expensive hospitalization costs that these conditions generate. Is that something that definitely needs to be considered when you're talking with your finance team and really understanding, especially in this recessionary environment, how to take into consideration. And so this gives you an example of how we take into account the demographic, geographic, as well as the stop loss variables to help employers understand how this is going to come to fruition with regards to their medical spend in 2020. McKelly, I'm at my time, so thank you.
Great. Thank you, Tim. Thank you, Frank. Very well illustrated. Appreciate you guys taking us through that. And you hit your time, so this is great. We got momentum, people. This is good. Wonderful. So pivoting from that to really the pharmacy strategy, which is a really big component. And if you can think about how things like COVID may play out, it may become even increasingly so as we start getting towards more permanent solutions. So we have a great team from VPS joining us today, Armand Delanchian, Doug Rasmussen, and Craig McGovern. Thank you, gentlemen, for being here. Appreciate it. You guys are going to tag team your way through the topics. I'll turn it right over. I think, Armand, you're starting, correct?
Great. Thank you, McKelly.
Yeah.
Thank you.
Yeah, my pleasure.
Good morning or good afternoon, depending on your location today. But as for me, I'm enjoying the sunny weather here in South Florida. Like McKelly said, my name is Armand Delanchian, and I have a couple of my colleagues on the phone. Doug Rasmussen, who's one of our clinicians, the AVP of Clinical Pharmacy, and Craig McGowan, who heads the analytical team. And we do have this combination of different people. As pharmacists, we feel like we know the secret handshake, if you will, and we certainly make sure that there's a lot of analytics involved with what our recommendation is. Next slide, please, McKelly. So I wanted to maybe just touch on something that I think everybody knows, and that's how different the pharmacy landscape is. For the past 10 to 15 years, the pharmacy landscape has totally changed. It used to be just a very small portion of the overall cost, but now it's become a pretty significant portion of the overall healthcare cost. In fact, 87% of the plans are making pharmacy management a priority. They're finding 15% of patients drive 94% of the drug spend. And you can imagine what those drugs are like: specialty drugs, biotech drugs, gene therapies that are coming to market one after another. On the next slide, I like to just basically let you know what we want to cover, what our team wants to cover in the next 20 minutes or so. And those are certainly strategies to choose the right PBM. Tim talked about a little bit about carve-in, carve-out. Certainly we want to touch on that, what kind of an impact that has on overall contract language and pricing and so forth. But we can't talk about pharmacy benefit administration without talking about the best practice for clinical services. Clinical pharmacy overall is a key component of certainly managing drug costs. And so it's not only for cost, but it's only for making sure that your participants are getting the best care. Specialty pharmacy being part of that, obviously. And we'll touch on some of the COVID-19 treatments, but I have to tell you right now that this area changes on an hourly basis. There are actually some new information being released on new drugs, new vaccines, and so forth, but we'll cover what we know as of at least a few hours ago. Next slide, please. So to talk about the carve-in and carve-out, just to start with a definition would be probably the best place to start. Carve-out, as the term indicates, is basically taking out the pharmacy benefit administration and carving it out of the medical and placing it with a third-party administrator, one of the either a pharmacy benefit administrator or a pharmacy benefit manager. And a carve-in would certainly be opposite of that, where the medical administrator is administering the or processing the claims. So maybe let's examine the some of the differences and the specifics. So under a carve-out situation, certainly there is more flexibility in pricing arrangements. There are many types of different pricing arrangements, either at with discounts and rebates, pass-through, or traditional models. So depending on your fingerprint on the benefits, pharmacy benefit needs of the employer, you can certainly play around which model fits your fingerprint. There is within a carve-out, and I'm just going to obviously touch on some of the highlights. There is more long-term strategic planning and more analytics involved, and you have access to more detailed reporting as far as the when it comes to checking or evaluating utilization, evaluating different drug pattern use, and so forth. So maybe let's switch to a carve-in situation for a minute. So the carve-in, even though there are some advantages to carve-in as well, I don't want to necessarily say it's totally out of the question. Carve-in, for example, is an integrated program, and potentially it helps the employer and the plan to have less administrative oversight. On the other hand, you don't have as much of a flexibility when it comes to sort of trying to make the pharmacy, the pricing structure, or the model fit your type of benefit design. You're offered a off-the-shelf product because that's being administered across the board. The reporting tends to be not as analytical and as deep, so you tend to get some high-level information where it may make your job harder to certainly make the design better and the administration better for you. As far as I want to emphasize on the point that regardless of what your buying approach is, that's carve-in versus carve-out, the biggest component and the overall management is the clinical management and the overall pricing management of the plan. So the first step is to purchase well, but on an ongoing basis, you have to consider an ongoing strategy and an ongoing management. In fact, 60% of employers have said if they transition from a fully insured to a self-funded plan, they will definitely consider and evaluate a carve-out pharmacy program. So with that, I want to pass the baton to one of my colleagues, Craig, just to make sure that we cover some of the contractual language and some of the games that may be played with pharmacy contracting. Craig?
Hey, thanks, Armand, for going through that for us. So we want to talk about the comparative analysis complexity and the games that are being played by some of the health plans and some of the PBMs in their contractual guarantees. And what makes the modeling so complex is that these different buckets here, as you see on the page, can be weighted a lot differently between each proposal. And so like Armand said, we want to buy well at first, right? That's the first step, purchasing well. And here are the buckets that go into that. So you have your data fees, that can be your integrated accumulators, your discounts, whether it's a pass-through model or a traditional model with the spread margin pricing, network spread, some of your fixed fees that may be a PPM credit, some of your consulting fees, things of that nature. Then the two larger buckets, right? The rebates. We all know that rebates are a hot topic for the last few years, at least, right? But understanding the strategy around rebates, the commitment, the payment frequency, what's included, what's excluded from the rebate guarantees, and then our clinical fees. Clinical fees, like Armand said, is the long-term component, and understanding what programs to pick, understanding what may have a financial impact if selected, and things of that nature. But again, so this page here just signifies how complex it can be when evaluating the contracts. And if we're not understanding completely how the contract works and what the PBM or health plan is trying to do, your results can be a bit errored, if you will. So as we go to the next page, we want to talk about what to look for in the ARPS contracts. And I can't hit on this enough. The fine print is more important than some of the numbers that we see on the surface value. So always, rule of thumb, dig into the fine print, understand what's going on. And certainly this isn't an all-inclusive list, but again, we want to highlight some of the things that are top of mind that can easily be pulled out of the contracts and understand. And so we want to understand what drug categories are excluded from your discounts and rebate guarantees. Top of mind, a large portion of your specialty claims could be excluded, right? So those are your limited distribution drugs or exclusive distribution drugs. A lot of the PBMs and health plans typically exclude those. And so you want to be able to normalize the data to understand that, hey, the rebates aren't getting paid on these drugs. And so they may pass them through, but they're not a part of the minimum guarantees. We want to understand the rebate commitment, the payment frequency. Payment frequency being, we look at rebates as a retrospective discount based on your utilization and volume. Typically, they're paid quarterly within about 90 days. But some of the health plans, you can drag out a bit longer, 150 days, 180 days, understanding that. So understanding your cash flow, and if you're based on a cash basis method or accrual basis. And then specific drug classes that are rebate eligible. Like I mentioned, the LDD drugs, but also sometimes HIV drugs play a part in that bucket. And that can be, again, impactful to your overall results if you're not understanding what's rebate eligible. From a commitment perspective for rebates, we want to understand, is it a PEPM rebate credit off of your ASO invoice? Might it be a per brand guarantee? Is it a percent share or the greater of methodology? So just understanding, the differences in what the commitments are and the frequency of payments can help you be able to evaluate those a bit better. Another important piece is, how do we get out of the contract? Is there an early termination provision and or market check? Early termination, we typically see that, yes, you can get out your contract, but we're going to withhold something, whether that be your rebates that are earned and unpaid, or a PEPM or PMPM membership-based fee based on the number of months left in your contract. But again, we want to understand, how can we get out our contract? Do we have to satisfy the entirety of the term? A market check provision simply enables you to enables plan sponsors to keep the pricing fresh, having the ability to go out to market and negotiate with your current RX administrator based on market conditions. And we all know that the pharmacy landscape is ever changing, specifically the specialty bucket, and how volatile that can be in terms of rebates and discounts. Your reconciliation offset language, and this is another fine print that, while in an analysis is not as impactful, but it's part of that contract language, the fine print, that we want to call out. We want to be able to understand, are they offsetting within the guarantees? And that can be across each point, different points of sale, within each point of sale at the component level. But again, understand it's a weaker provision in some of the contracts we look at, but understanding if that's applicable in the contract. Clear definition of drugs. So clear definition of a generic drug. What is a generic drug? What is a brand drug? And a specialty drug. Being able to identify some of those maybe house generics that are being filled at pharmacies, or your single source generics Those are two top of mind that come into play, where sometimes one PBM counts them as a generic and other might count them as a brand. And it's up to some of the consultants to be able to normalize the data and be able to provide that to the clients. And then last but certainly not least, your network and formulary strategies. What type of, are you in a narrow network, a broad national network, where all the pharmacies are included? And then your formulary strategies, is it a rebate-driven formulary? Is it your more broad, open formulary? And you want to be able to compare apples to apples as best possible from both of these strategies. So again, this is not an all-inclusive list, but we just wanted to point out some of these high-level things in the RX contracts that we see on a daily basis. And from that, we can transfer over to Doug for clinical management best practices. Thank you.
Hey, thanks, Craig. So it looks like I have about 4 minutes to go through these slides, and I am a clinical pharmacist by training, and clinical programs should focus on improving overall health and ensuring safe and effective use of drugs, thus decreasing the drug's costs. You know, whether you're fully insured or self-funded, make sure your administrator has these safety features of step therapy, quantity limits, and prior authorization in place. Members might think that these are hoops that they have to jump through in order to get a medication their physician has prescribed, but know that these strategies really ensure safety, quality, and appropriateness for the member and for the plan. Let me give you a few examples of each. So step therapy, if there's 5 drugs that all do the same thing, it doesn't make sense for a medical carrier or a PBM to carry all 5 drugs. Usually you'll partner with 2 or 3 manufacturers. That way you can get increased discounts and rebates for those medications. Quantity limits. I really think about quantity limits as a safety measure. If a patient wants 3 albuterol rescue inhalers in a single month, their asthma is not being controlled. They need to go and talk to their physician to get that asthma under better control, so they don't need so many rescue inhalers. Prior authorization, this is just to make sure that the physician is checking all the boxes, making sure that drug is the most appropriate and safe for that member. There's some other methods, and usually these are buy-up, you know, increasing adherence, helping that patient take their medication as they should, which should decrease medical costs. There's disease management programs, patient-specific counseling. So think about someone who's on antidepressants, where a pharmacist or a nurse can reach out and talk to that member and see how they're doing. And lastly, controlled substance programs. You know, these came out 2.5 years ago and really helped us with, you know, our addiction issues that we had in the area. So if we switch over to specialty pharmacy, very, very expensive medications, right? And the first and foremost thing that you want to do is that you want to have an exclusive specialty pharmacy. That really does save costs for you. If a member needs something urgently or on an emergency basis, there are policies where they can get those medications for that. Just like other formularies in specialty, you should have a specific exclusion-based or indication-based formulary just for specialty agents. When I'm saying indication-based, I take the example of Humira. Humira has 10 indications. It treats 10 different disease states. And so you might use Humira for your rheumatoid arthritis, but if it's written for Crohn's disease, maybe they use another medication for Crohn's disease. Quantity limits, no more than 30-day supply. And if it's a oral oncology agent that has a lot of adverse drug reactions, maybe you only give a 14-day supply because you don't want drug to be wasted. Specialty copay coupons, I could do an hour on this. Just know that you don't necessarily want those manufacturer dollars to go towards the accumulators. And lastly on this slide, things that we're looking for, third-party vendors. Maybe you don't want the person who approves that medication to also ship the medication. That could be a fox watching the hen house kind of issue. Drug tourism, you can go to Grand Cayman Islands, get 3-month supply, every medication and come back. And there's also vendors that are helping members access free drugs. COVID-19, really quick. Different types of testing. Most of us have heard of PCR. I'm really looking forward to the antibody test because maybe I've already been exposed and I can be free and leave the house. Treatment, like Armand said, it changes hourly. Literally, this slide was finalized on Friday, and many different things are occurring. Hydroxychloroquine and chloroquine have really fallen out of favor, so not really seeing those too much anymore. And on my last slide, let's talk about vaccines. A lot of trials worldwide. For a science geek like myself, very, very excited because we're actually building these gene vaccines. We're not growing them in chicken embryos. This will bring the vaccines to market much, much quicker. So instead of a typical 5 to 10 years, we're talking about a matter of months of bringing these things to market. Lastly, drug shortages. The top three are outpatient medications, and really aren't seeing too many issues with these when we talk to our PBM partners and our medical carrier partners. The bottom two we are having problems with. We're struggling in the inpatient area around sedatives and paralytics for people that are on ventilators. And then there's the high blood pressure medications as well that my pharmacy friends are having difficulty getting those drugs. That's what I have. Be sure and forward any questions. Thank you. That's great. Thank you guys, Armand, Craig, Doug. Appreciate having all three of you here to share your expertise, but thank you for your time, and you did a great job taking us through some really key things to focus on. So appreciate you sharing that knowledge with us and that guidance. Very helpful. Okay, another person who shares guidance for a living is our own Joanna Castillo. I'll give her a quick plug because she's a humble person, but Joanna and her team's blog posts on Sequoia.com are some of the most trafficked pages that we have on the website. She does some great work providing insight and translation on what's going on around compliance, and particularly, obviously, a lot of interest in COVID-related things recently. But here to talk about some of the considerations in the context of self-funding, I wanted to turn it over to Joanna. Hi, Joanna. Oop, you may be still on mute, I see, from my side, at least. There you go.
Can everybody hear me okay?
I can, yes. I'm sure they can too.
Perfect.
Cool. Hi. The floor is yours.
Hi. So excited to be here today to talk about my favorite topic, which is legislation. But yeah, so I'm going to really discuss sort of legislation, some old and some new, as well as, you know, really how it relates to self-funding. So, and here's how I'm going to break it down. So first, I'm going to talk a little bit about your fiduciary responsibility under ERISA when you have a self-funded plan. And I would be remiss not to talk a little bit about COVID-19 and how it's really affecting group health plans right now, especially some fiduciary duties that you all have. And then two, I'm going to talk about the compliance distinctions when you move from a fully insured plan to a self-insured plan. Okay, so let's start out with ERISA. Can't say that ERISA is a fan favorite per se, but it is there for a reason. So I thought I would give you a little context about how ERISA came to be. But really, this legislation came up when the public was really thinking that pension funds were being mismanaged. So back in 1963, a long time ago, there was a car company called Studebaker, and it was closing one of its plants. And it turns out at that time, when the company was closing down, the pension funds were severely mismanaged, and they did not have money to pay their employees. And so the senator from Indiana, where that plant was located, sort of brought this legislation, and then 11 years later, we had what we know as ERISA today. And really what ERISA does is it provides remedies for plan participants and also requires certain things of employers that are managing group health plans. And I thought I would take a little bit of time to talk about, you know, why do we care about this stuff? So fiduciary duty, really fiduciary duty is going to be when you're exercising some discretion over the plan. So think about denying or approving claims, selecting and monitoring your TPA. You know, that's different than when you're making business decisions under the plan. So think of a business decision as, you know, what contributions you're going to give towards the plan, whether or not you establish a plan or you're going to terminate your plan, right? Those are business decisions, and the fiduciary stuff is more about the exercise of discretion. And so why do we care about this stuff? You know, why do you care if you're acting in a fiduciary capacity or not? And the reason you care is because there is a good old claim that can be brought called breach of fiduciary duty. And so you want to know when you're acting as a fiduciary and when you're not, because when you're not, there can be no claim for breach of fiduciary duty. And if you breach your fiduciary duty, the potential liability that you are facing would be personal liability to make the plan whole. You could also face being barred as a fiduciary, and also civil penalties that would be enacted by the DOL or IRS. So that's why we care about ERISA and when you're being a fiduciary. And again, just who's a fiduciary, you know, it's going to be anyone exercising discretion over the plan. So, you know, it could be your third-party administrator if they have fiduciary discretion over your claims and appeals. It doesn't necessarily have to be the person that's the named fiduciary in your plan. It's really anybody that's acting in that capacity. So you really want to think about function and not necessarily title. As a plan sponsor, the employer is always going to be a fiduciary. You also might want to name an entity, so it could be a board of directors or a benefits committee, but you always have to name a fiduciary in your plan, even though you're going to have lots of other potential fiduciary actors. Okay, so I talked a little bit about benefits committee, and this is a big question I get from our clients. They want to know, okay, when I go self-insured, do I have to hire a bunch of people to take this on? How difficult is it going to be? Do I have to draft documents? Do I have to have a benefits committee? And the answer is no. You do not have to have a benefits committee, but you can. And the reason why certain employers enact a benefits committee is really to create some structure and procedures around how the plan operates. So I see this really happening when employers become very large. They want to set some structure and really protect themselves against an audit. And so where you would begin is you would start with a committee charter. And once you have the charter, you would need to essentially state who is going to be in that committee. And I get a lot of questions about how many people should be on this committee, who is normally on the committee. You're typically going to see between 3 and 7 members on a committee. It's usually some folks with some plan expertise. So think finance, HR, legal, maybe somebody from your security team. You're going to draft a charter. You're usually going to do that with your legal counsel. And really what this charter does is it delegates clear roles and responsibilities for the various members on the committee. And it's going to help you essentially meet regularly, keep detailed records, and it's going to eventually protect you against audit and just create some really clear procedures for your plan. But again, you absolutely don't have to have a benefits committee. This is just a way to create more structure. All right, so we've got some basic fiduciary duties under ERISA that are important to go through. So these are the top 5, everyone, that you want to just kind of be aware of when you're acting in a fiduciary capacity. So you need to act solely in the interest of your plan participants and their beneficiaries. You want to carry out your duties prudently. That means that you know what your responsibilities are under the plan and that you know how to carry those out. And if you don't, that you get the education that you need to do that. 3, stay reasonable. Pay only necessary expenses under the plan. So this is really where your service providers come into play. You want to compare and contrast them. You want to understand what you're paying them for and what they're doing for your plan. Number 4, this is probably the most important one when you're a plan sponsor, but you always, always, always want to follow the terms of your plan. That means that you know where your plan documents are. You've done a cursory review of them, especially if they're drafted by an outside party. You want to understand what's in those documents because that really tells you how the plan is supposed to be run. And then finally, you want to manage your assets well. If you utilize a trust, you want to make sure you're following those rules. Okay, and then I would be really remiss to not talk a little bit about COVID-19 and the effects that we have had in the last 2 months when it comes to legislation and group health plans. So first of all, we've seen a lot of changes really happening, and it's hard to keep up. And I know my team's been busier than ever, really just digesting all of this legislation and presenting it to you. So I thought I'd give a high-level overview here, but two really important pieces of legislation that came out were that plans now have to offer free COVID-19 testing along with the associated visit, and they also have to offer free preventative treatment once it becomes available. So these apply to all group health plans, including self-insured plans. And then the other two here are really some actions that you can take, but you don't have to take. So we had some legislation come out that basically states for telehealth plans that are so popular right now, telehealth services, everybody's utilizing this. High deductible health plans are going to be able to offer telehealth services even when not COVID-19 related without a deductible or a lower deductible than the HDHP plan currently has. And this is going to be available through the end of December 2021. So this is something that you could offer. That's why it's important to sort of keep up with legislation so that you know what's available. Before this legislation, this was not something that you could do, but now you can. And so as a self-insured medical plan, this is something you could implement. And then in terms of over-the-counter medications, you can now reimburse them under an HSA, FSA, or HRA plan. We've also seen a lot of mid-year changes happening. So this second bucket here, obviously employers are having to make some really tough decisions right now, especially due to financial concerns or even health concerns that employees are facing. And so even though you have a fiduciary duty to act in the best interest of your plan participants when you're carrying out certain functions, when you're making business decisions under your plan, you're not acting in a fiduciary capacity. So there are a lot of changes that you can make mid-year, and I've just listed a few here that I've really seen happening as of late. And those are special enrollment periods being implemented. So certain employers are allowing employees to jump on the plan mid-year. So that's something to think about. Increasing or decreasing employer contributions to a plan, that's something that you can do mid-year. And finally, a big one is I've seen many employers dropping the eligibility requirements under the plan. So essentially, before we were saying a lot of, you need to work 30 hours to be on our health plan. I'm seeing employers at this point dropping that all the way down to 0. When you're fully insured, you really need agreement from the carrier. You might need to do some negotiating. As you know, there are tax credits on the line for keeping benefits going for many of your employees. So this is really important right now. And when you go self-insured, you have a little bit more leeway around what you can do. The only caveat is that you really always need to check in with your stop-loss carrier. Even though it tends to be easier to make changes, your stop-loss carrier really should know about massive changes like this, and they should be agreeing to those before you implement them. And then finally, I'm seeing some carrier refunds happening right now due to low plan utilization. So you might, in the near future, if you are on a fully insured plan, currently, you might be seeing some refunds coming back. And so I thought I would just talk about refunds in general a little bit and sort of what you need to be aware of as a fiduciary. So when plan funds are coming back to you, you need to look to your plan documents really first to determine what to do with those plan funds. Is this something that the employer can retain, or are these really plan assets that should be distributed back to employees in some way? And your plan documents will always often at least govern this. If the plan documents are silent, you usually look to employer versus employee contributions and those various percentages. So if a certain percentage of employee contributions are going into the plan, then generally you would want to attribute those to employees and then do a distribution back to employees. You generally have 90 days to do this. There are 3 ways you can do it. You can either distribute the funds back, you can enhance benefits with the refund that came back to you, or you can essentially create premium holidays for future premiums that employees are paying. And then finally, I definitely have to talk about this. We had a disaster relief notice come out late last week. Many of you have probably seen an email that came from us on Friday about this, but this is huge legislation that came out, really changing what some of your fiduciary actions need to be in the coming months. So effective going back to March 1st, and through this national emergency, we don't have an end date for this yet. So this could be a while, and then tack on 60 days from the end of the emergency. Employers are really going to have relaxed fiduciary duties at this point. So in terms of providing required ERISA plan notices, so think about your plan documents, your SPDs, COBRA notices, all of those things have a very relaxed time frame now. You basically have this entire time during the emergency, add another 60 days to that for employers to get these things out to their employees. So that's really been a huge relief for employers due to just all of the craziness that's going on and the amount of legislation coming out. It's nice to see a little bit of relief. In turn, we also have some relief when it comes to electronic disclosure of these notices and plan materials. So the government has essentially said, hey, we understand what's going on right now and that you need to be able to give disclosures electronically. So they are allowing disclosures to be made via email, via website, or even via text in some cases. So if you're utilizing the Sequoia mobile app, many of the notices are there for your employees already. So this is a huge relief. Employers don't need to print out and mail things right now, and they're going to have a lot longer time to do this. So we do recommend giving notices out to employees if possible, but just know that you have a very relaxed requirement here. And then finally, employees also have a relaxed requirement. So they are going to have much more time to elect for their HIPAA special enrollment rights. They're going to have a much longer time to elect COBRA, to pay COBRA premiums, and also to do claims and appeals. So it's really amazing, you know, starting back to March 1st, we really have a pause in time for everyone. And so as an employer, you just need to be aware of these rules. You need to be allowing employees to come onto the plan if they have a HIPAA special enrollment right. They need to be allowed to elect COBRA even outside of their normal period of time. So the main thing you need to know as a fiduciary here is that if you have third parties assisting you with these things like claims and appeals or COBRA election notices or COBRA premiums, the main thing is to sync up with those vendors, make sure you're monitoring them well and that they know about all of these changes. Okay, so there are 5 big steps for mitigating risk, and I'm just going to blow through these quickly because you can look back at them anytime, but you want to carefully monitor your service providers, make any required disclosures. Obviously, under COVID-19 right now, you have a much longer time to do this. Understand your plan and your responsibilities, file timely reports, and finally, the best thing you can do is really keep detailed records around your decisions that you're making for your plan. And finally, we have some regulatory changes when you move from fully insured to self-insured. So I thought I would kind of go through the big 4. So under the Affordable Care Act, you have to do ACA reporting when you are self-insured, no matter your size. So as you know, usually when you become an applicable large employer, you have to do ACA reporting. When you are self-insured, you do it no matter what. Under the ACA, there's also something called PCORI fees that become due for you. So PCORI fees apply to self-insured plans. It's essentially a fee that you pay that goes towards research, and Sequoia does help you with these calculations, but it is something that you have to do once you become self-insured. Obviously, under HIPAA, when you're self-insured, you have a lot more access to protected health information. So it's important that you do put safeguards in place. You do have policies and procedures in place, which is something that we at Sequoia help you with. You should be doing annual training for persons that will likely come into contact with protected health information. So just a lot more that you need to be aware of when it comes to PHI and HIPAA. Third, non-discrimination testing. I'm sure many of you are already testing your cafeteria plans. When you do become self-insured, there's a little bit more that you need to do. There are some different rules that apply, and so we do recommend having your plans evaluated at least once. You can do that with a vendor or with an attorney so that you have something on file. But the gist here is that you cannot favor your highly compensated folks, just very similar to what you do with your cafeteria plan. And generally, you should be fine as long as you're offering the same benefits to your entire population. And then finally, a good thing about becoming self-insured is that state insurance laws no longer apply to you. So it really helps kind of take out some of the muck of all of the thousands and thousands of state insurance laws that apply. So an example of this would be, you don't need to follow all of the various state COBRA laws when you become self-insured. You just follow the one federal COBRA law. So that can really help with administration and all of the things you need to be aware of. And then finally, if you have employees located in San Francisco, you need to be aware that once you go self-insured, some of those requirements change and you look over the spend on an annual basis versus quarterly. So there are some changes there if the San Francisco Healthcare Security Ordinance applies. And the only caveat there is that I do see high deductible health plans sometimes falling short of expenditure requirements because those plans tend to have very low utilization. And so these are things, if you become self-insured, that we will be talking to you about, making sure that you're very well prepared. And then finally, if you're wondering how in the world are you going to keep up with all of this and know everything that you need to know, just know that we're here to support you. We have so many ways that we bring information to you through our Sequoia blog, our online platform where you can sort of manage all your compliance in one place. And also just wanted to point you to our COVID-19 page where we have all of our COVID resources for you as legislation is constantly changing and we want to make sure you stay up to speed. So thanks very much.
Awesome, well done. And you know how to warm up a CMO's heart. That's an excellent slide. Thank you, Joanna. Very fluidly presented too. Appreciate it. Great, so we have 3 more presenters and I'm very excited to introduce you to our next one. Hopefully somebody, all of you know, Leslie Grady, who has been central to taking so many of our highest profile clients into self-insurance. Brands that you're definitely getting some exposure to in this COVID era. I know I am, but learned a lot of lessons and things to take forward. And today she's going to share some of those best practices and pitfalls with us. So Leslie, how are you doing?
Awesome. Can everybody hear me? Hear me, McKelly?
Yeah, you sound great.
Okay, yeah. Great. All right, let's to the next slide. So talking about stop loss in about 14 minutes. There's a lot of terms here. Those of you that are self-funded today might have heard some of those terms. There's probably going to be some new terms for you guys as well here. Those are fully insured. Those that are fully insured today, there's going to be some new terms here. So really what I want to get out of this next few minutes is kind of giving you, as your consultant, when we're thinking about stop loss coverage for you, what are all the little tips and tricks that we're thinking about along the way? And slightly different than pharmacy, as Craig, Doug, and Armand mentioned, there's lots of fine lines within pharmacy, which really impacts your potential financial savings in a carve-out or a pharmacy contract. Here, it's less about the financial side, and it's actually more about the risk side with stop loss. So just we're going to kind of talk through some of the stuff. We're not going to go as deep, but really try to show you guys as you guys get this deck at the end of this session, so you'll be able to see some of the best practices as we go into the stop loss side. Tim mentioned earlier really kind of a comparison between fully insured and self-funded. So if you look, if you look over to the right-hand side here, the 2 pieces we're going to talk about today is specific stop loss protection, which protects against one large claim. So you think about one, a premature baby on your plan that could cost $2 million. Specific stop loss is protecting against that. Aggregate stop loss is protecting against what we call ordinary claims or first dollar claims. So claims that are under that, whatever stop loss limit that you have, all of those claims. So you think about it, there's not kind of like big things need to happen. What I used to always say, many of the folks here used to say, oh, if we had some kind of, global pandemic, boy, that might be when aggregate stop loss would kick in. So here we go. So let's go to, go into the next slide. I would say I'm going to try to bucket this into 3 things along the way. Choosing the right stop loss carrier, choosing the right stop loss contract, and choosing the right deductible and coverage level. Kind of 3 distinct things that I want you to think about when we're choosing a stop loss carrier or choosing stop loss. Okay. So choosing the right stop loss carrier, you kind of have 2 options. I would say many folks think when it comes to stop loss coverage that the easiest, safest approach is bundling it with whatever administrator you have. So if you're with a Blue Cross Blue Shield, an Aetna, Cigna, a United Healthcare, many of those carriers offer stop loss coverage as well. So there is an option of bundling that in. And there's some advantages of that. Some people think there's greater purchasing power, generally you'll get immediate claims reimbursement. So if you did have a $2 million claim, when it's all packaged in place with one vendor, you might not be out of pocket that $2 million. And generally, I'll keep it pretty general, but there's no contractual gaps. And what I mean by that is when you have 2 different vendors, so if you look at the unbundling side here, you're going to have I'll call it the underlying plan, but the plan that covers things for your employees, the SPD that you see, the EOCs, that's what your plan is covering. And then you'll have a separate stop loss contract. And that stop loss contract, you generally want to think are covering the same things, but you need to look at the fine print to make sure they're covering the same things. Real typical, easy one to understand is experimental procedures. Back in the day, a bunch of years ago, many times you would see things that are in a clinical trial. While it might be covered under the underlying plan, we saw the stop loss carrier would exclude things like that. So you really just want to make sure there's no contractual gaps. And generally, that's not a concern when things are bundled in. Now, unbundling, you're working directly with a stop loss carrier. You also might hear the term an MGU, a managing general underwriter. They also write stop loss coverage. There's dozens and dozens of different ones out there. Some are bigger names, like we had James earlier at Sun Life. So those are some of the bigger stop loss carriers that are out there. And then you'll see little, MGUs that are out there, names you've probably never heard before. But one of the reasons why people consider carving it out is many times if you carve it out, there's more competition that's out there. So that'll drive lower stop loss pricing. And if you think about it, if you could save $200,000 or $300,000 on a cheaper, a less expensive stop loss contract, that's real money. There's also more flexibility in contracts and underwriting. So when you're working directly with a stop loss carrier, you can design those contracts. You have a little bit more flexibility than if it was bundled in. Some also might consider an advantage of unbundling it as well as a second review of claim payments. So when a stop loss carrier is reimbursing claims, they're going to look at every claim, even the first dollar claim that was paid, and they're going to be looking at it to make sure all those claims were paid correctly. Some people like that, to say, hey, wow, I just got a second review from whatever United Healthcare paid or Aetna paid or Cigna paid. So that's an advantage. You might hear the term like, the hen watching the chicken house or something like that. So those are 2 best practices. And over to the right-hand side, what you really want to make sure is that you have experience with your claims administrator and also your pharmacy benefit manager. So any stop loss carrier, you want to make sure they've worked with them before. And I would also say the ability to take their standard claim reports in all situations is really, really important. Many times when you have a stop loss claim, especially a very, very large stop loss claim, the carrier might come back, the stop loss carrier might come back and say, oh, I want to see case management notes, or I want to see a pre-certification report. And standardly, that might not be part of your administrator's package. So you really want to make sure when you are choosing a carrier that whatever data is available, they're going to take that for claims reimbursement. Also look to things like service guarantees, claim turnaround times. And I would say most importantly on this side is that they're retaining 100% of the risk. Some of the smaller name stop loss carriers that are out there, there's actually a couple reinsurers behind the scenes. So what you want to do if you have a $5 million claim that's out there, you want to make sure the person that you're working with is the person that's making the decision. So that's really important on the front end. Okay, so now let's go into choosing the right stop loss contract. Okay, we'll start here with stop loss coverage across group industries. There's a couple things that you're going to look at when you're thinking about the right stop loss contract. Number one, we talked about specific and aggregate stop loss. Generally, aggregate stop loss is going to cover claims that hit generally over 20 or 25% of an expected claims cost. As companies get bigger and bigger, and as companies get more, I'm going to call the claims data get more and more credible, they don't have aggregate stop loss anymore. I would say in light of COVID, we're probably going to see more companies choose stop loss and get that protection in 2021 based on the pandemic that's out there. Now let's talk about different types of stop loss contracts. So some of you might have heard the terms 1212, 1215, 1218, 2412, paid contracts. There's lots of different types of contracts that are out there. A little bit confusing, so we tried to simplify it here for you. But when you look through, what those numbers are talking about is when claims are incurred, are they going to be covered under the stop loss contract? And when claims are paid, are they going to be covered under the stop loss contract? So I'll just kind of simplify it for you. If you look at a 1212 contract, and you got to think about lags in claim payments. So generally, you might know if I incur a claim today, especially a medical claim today, there's going to be a lag in claim payment. That claim's probably not going to be paid until a month or two down the road. So that's where the contractual, the 1212 that we're talking about, really comes into play here. So what you want to know, you want to think about is, okay, is this stop loss contract, when are they covering claims that were incurred, and when are they covering claims that were paid? A couple tricks. What I would say is when you're fully insured today, you don't need, you only need the protection from here on out. When you're self-insured, you do need protection from claims that might have been incurred last year and paid in this year. So you can see we put a couple best practices in there. What I would say is no matter what, you want to make sure that you have the most contract protection. When it comes to large claims, you have things like subrogation, automobile accidents, different hospitals. There's lots of kind of dirty stuff that goes into very, very large claims that happen. So you really want to make sure you have the maximum contractual coverage provisions when you're thinking about stop loss. So over here to the right, I won't go through all of these, but over here to the right are really some best practices. When we at Sequoia are thinking about stop loss, we kind of go through each one of these to make sure that your stop loss contracts are hitting the mark. I would say the biggest ones here, that there's no gaps that we talked about, let's talk about COVID for a quick second. Joanna had mentioned earlier, you guys might be making changes mid-year to your plan, COVID testing and things like that were covered at a different level than they were previous in years because it wasn't something we thought about. So you really want to make sure your stop loss contract and your stop loss carrier is covering those types of things. Okay. So let's talk about choosing the right stop loss deductible. I'll go through this pretty quickly. There's a lot of stuff that's on these pages. So when we're working with our clients, we want to make sure that we really do some deep modeling and some deep benchmarking when it comes to choosing the right stop loss deductible. So what you can see over here to the left-hand side, deductible selection tends to be closely tied to the number of the employees. It's not the only thing that you think about, but there's a general range. So we like to look at some benchmarking by the size, that your company is, and some of the most common deductibles. So that's one key point. If you're looking over to the right, a couple other things that you also might want to think about. You want to look at expected incidents at that deductible level compared to the premium. So in certain situations, you could see this situation here. If you have if you're this company and you have $100,000 specific deductible level, we're going to expect about 5 claims over that stop loss level. So does that make financial sense? Does that work? Is that what we might see going forward? Is that historically what you've seen? So we try to look at some of those key indicators to make sure that we're choosing the right stop loss deductible. One note is many times companies will ask us to look at historical experience and say, well, I've had no stop loss claims in the past. So let me go aggressive in a stop loss deductible level. Let me go higher. That's an indicator for sure. But with catastrophic claims, they're very unpredictable. So you can't really use claims like Tim had mentioned earlier. You can't really use historical claims on a catastrophic side to forecast your future claims. The other thing that we look at in terms of choosing the right stop loss deductible is what are the types of claims that are out there right now. Stop loss generally is there to protect against the unknown risks, not the known risks. So if you think about it, if there's a premature baby in the hospital right now and you're looking for stop loss coverage going forward, the carrier is going to know that and see that and price that into the risk. And there's a big range. So if you look in the top, the chart over to the right here, you could see malignant neoplasm cancer. The average cost of that is $188,000. But compared to the highest cost in this survey, the highest cost for that diagnosis is actually $3.4 million. So really, it can go the gamut with a bunch of these things that we're looking at. So really understand what your current risk profile is. The stop loss carrier will. We'll make sure that's priced in there, and that'll help you choose the right stop loss deductible also. Right. A little bit of delay. Okay, great. And I'll jump quick to here. I would say the last thing to think about in choosing the right stop loss deductible is looking at the top high cost claims also by industry. It varies very, very much. There's a lot going on in this slide here. But when we're looking at it, we're actually trying to look at the size of your company and also by industry. So you can see over to the left-hand side, we've got a bunch of different industries and then really showing the top types of claims that we're seeing, high cost claims that we're seeing by industry. And that will also help impact, the right decisions in choosing the right stop loss deductible for you. Many people might think, oh, I've got a young population, a young male-dominated population. Honestly, as we start to see more and more drugs come out there in the market, there's actually a place for lots of catastrophic claims and those demographics, which is a little bit different than we've seen in the past. Cool. So with that, I'll hand it back to you, McKelly. Thank you.
Great. Thank you, Leslie. That was very cool. Appreciate it. Okay, so we're going to switch gears now and invite up Marion Holt, who's the Director of Benefits Innovation at Collective Health. Marion, are you there?
I am here. Can you see me? Hear me?
Hi. Yeah.
See and hear me, I guess,
I can
right?
do both, yeah. How are you doing?
I'm well, thank you.
Awesome. Thanks for being here. So we'll change it up a little bit and almost kind of have a little bit of a chat. How's that feel? Kind of a laptop side chat, if you will. I'd love to kind of dig in. Let's start with your title. What a wonderful, cool title, Director of Benefits Innovation. Maybe start just explaining to folks a little bit about what you do with that role.
Yeah, so just to give context, and I guess to set context, I was a benefits leader for the past about 20 years, leading benefits for Salesforce, Uber, and most recently Lululemon, and came to a point in my career where I wanted to switch it up a bit. And so had been introduced to Collective Health while I was at Uber and had the opportunity to implement them while I was there. I got to love the product and the overall mission. And so I've had the opportunity to now switch gears a little bit and came over to Collective in September. And probably the best way you can think about my role is I'm really an internal thought partner, working across our product, working with current clients, and working with our sales teams, but really helping think through how we continue to evolve our product and services. So far,
cool.
It's been a super fun role.
Yeah, no, it sounds awesome. It sounds like you're in the right place too. Let's start with what you learned in the past, right? So in those roles at Lululemon and Uber and Salesforce, what were the grounds for making your decisions around a TPA or ASO administrator? What kinds of things were important to you for those types of companies at that time?
Yeah, sure. So I guess, to start off with, I mean, I'll be honest, and I would say, right, when my first experience with going self-funding was when I was at Salesforce. And, you know, I'll be honest, I think then I did go the ASO route, and the big reason for that is I just felt like that was the easiest transition, right? To be fair, though, I would say it was a bit of a different time back then, and I wouldn't say there were as many great innovative options that I think there are today, right? So I really do think you have a great field of options to consider now as you go the self-funded rate way.
And about what year was that, Marianne? Sorry to cut you off. The Salesforce years.
That was 2005, I believe.
Okay. Yeah.
Yeah.
Okay.
I'm trying to remember now. It was a long time ago.
Back then, yeah.
Yeah.
Sure.
Yeah. So yeah, and so that's why I say it's, you know, and I think of recent years, it's definitely changed a bit with just new providers coming out to the marketplace, right? And especially obviously with Collective Health. And so my second opportunity, you know, at Uber was to self-fund. And so there was really when Collective Health had come onto the platform. And so I was introduced to Collective Health and, you know, was really impressed by the fact that they had one ecosystem, right? So not only is it a TPA, but it brought together other components that I think are really important as you think about how you're delivering care to your people, right? So having that member advocacy, the member engagement, but then also, you know, aside from the member side, I think there's so many components that are super important for benefit teams as they venture into that self-funded space, right? And it's really making sure you also have those analytical insights into your data so you understand how your claims are trending and you can stay well ahead of it, right? And help make sure you're making the right decisions as you evolve your benefit strategy. And so one of the things I think that really caught my eye with Collective Health was that they do provide an employer dashboard that not only provides insights into your data, but it's real-time insights, which to me was super powerful.
Yeah, it seems like kind of the biggest area of innovation really has been around, you use the word experience, both for the employer and employees, right? It's really become almost consumer grade, if you will, which was very due. And then in the past, when you were at Uber, before you even knew about Collective, what for people who are just starting or on the one side of the line looking over at the other side, what were some of the fundamentals that you're looking at, like in addition to the experience, which let's say is the new decision criteria? What were the factors that helped you navigate or narrow down your decision-making process?
Yeah, I mean, so outside of like the member experience, right, and the data insights and analytics, I mean, obviously you want to make sure you have really strong networks and deep discounts, right? So you obviously, I think that's kind of at the forefront. You also just, I think, want to make sure you have a provider who is also has a strong care management program as well, right? Because that's going to be key as you want to manage your spend, right? So again, moving self-funded, it's a whole different beast, right? Where your company is paying out the claims. And as we just saw from Leslie, obviously you have the stop loss insurance, right? That's going to provide that protection. But it's going to be really crucial that you have those care management pieces so that you can be proactive in reaching those people that, you know, potentially are not already those high cost claimants, but also like how do you start identifying those rising risk claimants so that you can really start getting ahead of it. And so to me as well, like having a strong care management program was crucial as well for me. The other side too is you know, just the whole administration, right? So you know, taking on self-funding can be you know, a new venture for you, and so you really want a strong partner who's going to take some of the admin uplift off of your plate, so that you can continue to focus on strategy.
Makes sense. And you talked about care. It seems like a good segue to talk about, the impact of COVID. And so for folks, we started today talking about, certainly people are expecting a hit on their claims and their cost of healthcare moving forward. And I think a lot of people who are probably getting to a certain size are looking at, going in a self-funded direction, or maybe a little bit scared to pull back to try to see what happens with the impact of COVID. How does it change your consideration of who to go to, or what does it add to the decision-making process, if you will, the impact of COVID-19?
Yeah. I mean, obviously, right. I mean, the world has changed with COVID, and especially with benefits. I mean, I think the reality, right, is benefits are in the limelight more than ever now, right? I mean, even talking to some of our current clients and just talking to folks in my network, right? It seems like, no longer do benefit leaders have a seat at the table. They're now at the head of the table, right? And their leaders are really looking to them to figure out what we can do to ensure we're supporting our people in the right way, and making sure now more than ever that people actually understand the benefits that they have available to them, but also how do they access them, and just, how do they understand what they have. And so I think, from my perspective, like, you just can't hide behind the status quo anymore, right? You're really going to need partners, I think, who are flexible, they're nimble, can move quickly to support your people based on this new reality. I think it's really a time when you have to make smart decisions, and also, really think about how you can find efficient ways to give not only your people, but their families access to care, right? I think the other reality too, and what I think we've seen and heard, right, is I think businesses are going to be pushing us as benefit leaders, right, to really innovate in this face of change, right? I mean, virtual care is now more important than ever, right? And so you really need partners that are able to quickly flex and be able to reach your people and support them with the care that they need. I would say, though, what's interesting is, from my perspective, I think even before COVID-19, I was already seeing that the benefits landscape was changing, right? It's kind of what I was alluding to a little bit earlier. I think, we've really seen, as I mentioned, more and more entries into the marketplace, right, with vendors that have a focus on inspiring change, right? And not only that, but I think you've also just seen some of your traditional players, right, pushing to innovate. I think we're living in a new world, as I think has become more evident than ever, where you need to be able to reach your members, but also allow them to access care in different ways, right? And so you have to have those players that are going to be as flexible as possible. And not only that, but it has to be simple, right? I think benefits is, not an easy beast. It's confusing. It's a lot to take in. There's lots of different programs, and typically, right, when you set up your benefit strategy, there's lots of different components. And so how do you make it really simple for your members to understand, but also for you as benefit leaders to navigate and manage? And so, and I say all that, because I know we're talking specifically about choosing the right TPA, but I think as you go self-funded, and whether you're considering to go the ASO or TPA route, my words of advice, rather than taking the path of least resistance, which probably, I would imagine everyone is inclined to do today, I think it actually really does give you the opportunity at this time to really take a look at your overall strategy, and make sure that what you're putting into place is going to make the most sense for the world that we're living in today. So that's just kind of my words of advice. I'll stop there for a second.
Yeah, great. No, great advice. Great advice. let's advance the topic then. Certainly, in the world of Sequoia, we've been talking a lot over the last couple of years about the proliferation of HR tools, and obviously healthcare and the benefit space is one of the most innovative areas. It's led to a lot of unintended consequences, right? The fragmentation, like access to these things. You said access a lot, right? In that last piece there, because when access is kind of nowhere and everywhere, it ultimately erodes people's ability to use or discover as new things get rolled out. And it creates a big problem for HR to kind of bring it all together. How should HR be thinking about bringing this ecosystem together? And what are the different kind of paths people can take to make this less fragmented and easier for both the administration side and the employee side?
Yeah. And I really love this slide. I think it really does depict the reality of benefits, right? I mean, as I was alluding to, you have so many different components that go into a benefit strategy, right? So you've got all your health insurance plans, but then you've also got other additional programs like on-site clinics and wellness programs, and you need to focus on figuring out disease management, and then then it's also a matter of then figuring out how do you communicate all this. And so it's just it's a lot. And if you think about what your people are trying to understand, I mean, this is a lot. And not only that, but as benefit leaders, right, you have to manage all of this. And so the way we think about it, I think there's really two different approaches. And I think if you go to the next slide, I think that does a good job of talking it through, right? And so obviously there's the collective health approach, which, I'll talk a little bit more about. But then, first off, there's the traditional approach, I think. And as you're going the self-funded route, right, you're going to be focused on, okay, well, who do I need to have in place as a TPA or an ASO? So you may go down that route, but then I think it's going to be really important, as I've been speaking about, that you also have the member advocacy piece, you have the analytics piece. But in the traditional approach, really what's going to happen is you're going to start having these different solutions that basically you're trying to patchwork together, right? So they're still separate solutions, but you're just working to connect them all, which obviously can be a lot of work, and obviously, things could go wrong or could not, but it could also get really costly. The collective health approach, on the other hand, is a little bit different, where it's actually bringing all those pieces together for you in one system, right? And so you kind of get more bang for your buck right out the gate, because not only is collective a TPA, but we also have the member advocacy piece. We have care management. We have all the apps and the tools that we provide our members. And then we also have the employer portal piece, which really provides real-time insights into your claims. And so, there's definitely, as you're thinking about it, two different approaches, right? But we obviously are trying to simplify the overall experience for members as well as for employers by bringing it all together into one ecosystem.
Very cool. I think we have time for maybe one more question. Let's see, maybe we'll do a summary and you can throw in anything you want in addition. But so here's some best practices based on some of the advice you shared and some things you've called out prior to that. What do you think what's the hardest one for HR teams and particularly the benefits teams in there in terms of just getting ready and making the right choice?
The hardest one, oh gosh, that's a tough question, because I think, there are so many great options out there now, right? So I think we're living in a time where I actually think it's more fun. I mean, I've always loved being in this space, but I think it's a lot more fun being in this space these days. So I don't know if, one of these is more difficult because, I think there are options out there. And I think it's been really cool, just the direction that different companies are going with focusing on, simplifying, streamlining the experience. There's been a big focus on, value and evidence-based plan designs, right? to make sure not only are your members getting the right experience, but you're managing your costs, not only for the company, but also for your members. The analytics and data insights and analytics tool, right? I think the most important piece there to me, right, is to make sure you are able to have real-time insights. To me, that's just been a game changer with my experience with Collective Health, because you can walk into any meeting at any time with your CFO and just be able to pull up the portal and you have those real-time insights. And not only that, but it's bringing all of your program partners together as well. Our platform does incorporate other program partners, which again, I think is really important as you think about and are trying to solve for that benefits ecosystem. So you can really understand and measure the efficacy of your benefit strategy, right? You're able to see if your program partners are actually having the impact that you're hoping that they would have on your claims, which I think is going to be so important as you go that self-funded route.
Yeah, and so it seems like that's probably one of the biggest areas of innovation or just performance improvement, for lack of a better term, is just the timeliness of data and the sophistication of the measurement behind that. I know that's happening in a lot of places, and you're right. It makes it a very instead of looking in the rearview mirror and seeing how things are going, you can look more and down at your feet or maybe even in front of you.
Yeah,
which is
I think it's really important to understand. Yeah.
Go ahead.
Sorry.
Go ahead. Sorry.
No, I was just about to say, I think it's just so important that you know what is happening, not what has happened, right?
Yeah.
It just allows you to be more proactive benefit leaders.
That's great. Well, Marianne, thank you for joining us. Thanks for doing what you're doing over there at Collective Health. It seems like it's a great fit for you guys and for you personally. I appreciate you sharing your expertise today.
Yeah, great. Thank you for having me. Appreciate it.
Our pleasure. Our pleasure.
Okay. Bye-bye.
Okay. Bye. Okay, so actually, Marianne set up a really wonderful segue for Rod Reason, who's the CEO and co-founder of Springbuck, who's here to talk about you can't manage what you can't measure. We have a saying at Sequoia, you treasure what you measure, and it's certainly been the fastball for Rod since Springbuck was designed. So Rod, great to have you. How are you today?
I'm doing great. I'm assuming you can hear me well, so let's keep going. Famous management quote by Peter Drucker, you can't manage what you can't measure. And I am one of these 20-year plus folks that have been in the industry a long time and came from the brokerage industry and was frustrated. I was trying to help these employers manage their self-funded plans, but without the data or with this big, nasty binder that you'd get on a semi-annual or annual basis from the insurance carrier and trying to make decisions from it. So we launched in 2015 with this idea that you could use data to actually prevent disease. And that's actually our mission statement, is preventing disease with data. So going way beyond just getting access to data and visualizing it, but seeing how we could move to the prevention of disease, which obviously helps with the overall self-funded plan. So real quick, what I'm going to do is just kind of set the landscape for where we've been from a problem set. You can move to the next slide. And talk a little bit about the landscape from fully insured to self-funded and why an additional analytics layer may make sense depending on your size and what you're looking to accomplish. I'll step back and say I wrote down through the day several things that we heard that were unprecedented. There you go, Michaela. You can add that to your stats. But the panel talked about how COVID was changing COBRA subsidization, potentially increases there. Obviously, that affects the self-funded plan. We talked, Frank mentioned how elective surgeries will be affecting potentially the bar graphs in our historic claims and what we're maybe expecting there. I'll talk a little bit about that. Doug talked a little bit about all these new drugs and the testing and the fact that we don't even have NDC codes, which is the national drug codes, on many of this data sets because the drugs aren't even created yet. So you can't use a tool to even measure it because the data is not available. And then I'll also reset that March 16th, as we were, many of us, heading into March Madness, and March Madness became March Chaos because our brackets were all broken because no one got to play the NCAA tournament. The March 16th was when the AMA actually first introduced the CPT codes associated with COVID. So all of this is kind of like compressed into this small amount of time, but it feels like it's been forever because we've been doing this whole work from home situation. So I'll talk a little bit about how COVID actually affects, you as a big picture. So you can go ahead and go to the next slide. So let's talk about COVID real quick, and then time permitting, I'm actually going to do a little show and tell. As I'm the last speaker here, I'm going to do a little show and tell with the platform, so you get a sense of some capabilities that you can do with the tool or with the analytics tool that you keep hearing about. Certainly one of the big themes that we've heard throughout the day is that moving from fully insured to self-funded gives us new availability to data and new availability then to use that data for transparency. Obviously, there's a lot of complexity that goes along with managing your own plan. Hopefully, we've not scared you off. That wasn't the intent, I believe, today. The intent was to say that with the help of Sequoia and the many, many vendors that they work with, there is opportunity to have good thought leadership and education so that you're not going at this alone. So how does COVID specifically affect how we may think about self-funding? So the first thing we have on here is that COVID is exacerbating the problem. And certainly there are those in the industry that have come out with some form of prediction around how COVID costs are going to affect the overall population. What we'd say using our actuarial and data science knowledge is that there's just not enough data yet to really say. And that's hard when you're managing your own plan to have a statement of, I don't know. But what we can do is look at what we do know, and I'll show you some of the ways that we can actually think about how what we do know is actually interesting. One of the things on the exacerbating the problem is that there's this misnomer that just because elective surgeries are elective, that they're somehow not necessary or mandatory, or maybe they don't affect the overall health of the individual. One analogy we often say is that just because your knees and hips and joints aren't getting replaced doesn't mean that the same people that have cancer currently are able to get the same care. And in fact, that's what many hospitals have done, is they've reduced the amount of care that even cancer patients could have, because they didn't want to put those high-risk members at risk during an already exacerbated situation of COVID. So you have folks that have reduced care electively, or because the hospital systems haven't allowed them to get in, and those people may have additional issues coming back to the opening up of the hospital system. So that's something from a balance just to think about. The other thing that we point out is that very, very similar to any of us that may have had a dental visit scheduled during this last, say it was our 6-month visit, and it was scheduled on March 15th, you likely didn't go to the dentist, certainly not in the month of April, and probably not in the month of May. So the question is, will you have your dental visit in month 11 and month 12? Likely not. So very similar to the medical field, if you have annual visits scheduled, or for those that are on a regular visit to the doctor for gaps in care, for instance, those visits, what we believe will end up happening is that you'll just have a catch up versus a doubling up. Which could actually help your overall plan, and that's kind of an encouraging. So being from the data analytics space, we like to say we're going to give you the pros and the cons, and that's just kind of a way to think about it. Anyway, the data should be able to tell you. So so let's talk about COVID, and if Camille, if you want to go ahead and allow me to take control, I will share my screen. And that's a picture of myself, which you don't care to see. There we go. All right, so hopefully you can see the screen. Thumbs up from Michele. So when you think about self-funding in general, obviously you have new access to data that's unprecedented. Now you've got that in my head, Michele, so I'm just going to keep saying this unprecedented word over and over again. But you have new access to data that's kind of unique. So one thing about a separate analytics tool, in addition to all of the various tool sets that you will have available to you, is this idea of an agnostic third party that can collect your data ad infinitum, both historic and into the future. So if you think about from a historic view, to have good access to data, you want to be able to collect it from your United Healthcares or Anthems or from your TPA. And most of those vendors obviously are limited because they're not going to want to take other data from other vendors. The separate analytics tool allows you to have that access to the data. So when you're looking at your previous spend, it doesn't have to actually be with a certain TPA or ASO provider. You get all of it in one place. So what you can see here is a previous or past, a present, and a future point of view. And another point out here for the forecasting or for a future point of view is that you don't just get the how your plan is operating on a current basis, but with good combination of clinical and actuarial forecasting, you can see how is the plan running. And if we have CFOs on the phone or CEOs that are really concerned about making that leap over into moving to self-funding, obviously the financial risk there, this helps give some comfort in understanding how the plan is operating on an ongoing basis. Then what we can do is we can delve into areas like where are there opportunities to become clinically involved, not just financially, but clinically involved with the population, because the dollars are yours. The more you manage those dollars, the better the return is going to be for you as a population, both from happier, healthier people, but then also from a lower cost. So you can see areas like chronic gaps in care, which help you make decisions on the front end about what you should be looking to add within your population before you just go out and watch or add a musculoskeletal program or a mental health or a diabetes program. You want to see, is that really applicable to my population, both historically and then forecasted? And then, for instance, if you knew you're reading the CDC blogs or you're watching the various press conferences that they're doing, and you knew that those members that have asthma, coronary artery disease, COPD, diabetes, or hypertension were at the highest risk, you can quickly look at those chronic conditions within your population to see how is that population comparing from an overall cost historically, current, and then forecasted. The last thing I'll show, because I promised to end at 1:57 to give us time to wrap, is once we then do make some decisions, we want to be able to see how do things compare over time. So let's say that you're one of these really, really advanced employers and you're in a state that's not affected as much, and you went ahead and put into place a return to work phase 1 on May 1st. And you wanted to see also that you thought mental health was going to be an issue because people were staying at home, and you wanted to bring in a mental health, digital health solution. And you wanted to say, how did that affect my overall ER visits for that period of time? With a tool like an analytics platform, what you can do is actually start to measure that. And then, for instance, you wanted to say, I want to know all of those in the population that have had at least been diagnosed with a mental health condition and one chronic condition, which we've could talk about later in infinite item about the cost associated with mental health and chronic conditions. And I want to see, did those costs actually go down? Now I can. So with a couple of clicks of a button with an analytics tool, you can look at where should I be spending my money? How did my spend, the efficacy of those programs, as Mary Ann just mentioned, how did it actually work, and see, did this vendor actually do its job? So I'm at my time, as we knew it would be because I'm the last one of the day, but hopefully through this process, what we've gotten is an excitement around going self-funded, not a fear. So I'm going to pass it back to Michaela.
Awesome. Thank you, Rod. Appreciate it. Always love seeing you give your own demo. It's like watching Schumacher drive a Ferrari. It's pretty cool. So thank you for doing that for us. Yeah, in closing, Rod, you totally hit it. This, hopefully people came in today maybe with some gaps, maybe with some concerns, maybe with interest, but hopefully are leaving with a sense of empowerment and education and understanding on both a fundamental and strategic level of really what's available to you in terms of support, in terms of insights, and in terms of just the kind of expertise and guidance that can be provided. I want to just thank, of course, those of you who've been on with us. Hopefully it was useful for you. Give us your feedback on today's meeting and let us know things that you'd like to see in the future. huge thank you to this awesome panel of speakers and presenters we had today. Thank you. You added a tremendous amount. And a reminder to, again, use the questions if you have things that weren't addressed. I saw we received a couple during the content. Also just want to give a quick plug. I know return to work, or the path forward as we live in this COVID reality, and enabling our workforce is a topic everyone is trying to solve. We started a webinar series last Thursday, and the next one will be a week from Thursday on May 14th. And then ongoing every other week, we're bringing various thought leaders and experts to unpack that discussion. Next week happens to be unique because Sequoia is announcing a solution that we've built on our platform with some of our partners that supports the framework that we rolled out last week. So check that out if you're interested. You can go to sequoia.com and register for that. And there's actually a lot of other cool webinars, COVID related and otherwise, around HR best practices and other forms of strategy and thought leadership that you may be interested to check it out. And wanted to again thank the Sequoia team, thank everyone who was part of making today happen, Camille behind the curtain producing the show, and again, all of you, hope to see you in a webinar in the near future, and stay healthy and be well. Thank you.